Thanks for tuning in to your daily dose of quick real estate updates, local housing trends, and market data, plus tips, tools, and strategies to help you buy, rent, or invest with confidence. You're now getting ready with RealiCare Reports, powered by the innovation team, Cami and Rex. Now go grab your favorite morning breakfast, coffee or tea, and let's enjoy today's episode.
Welcome to the Deep Dive. Today we're heading down to Florida's Space Coast.
Brevard County.
Exactly. We've got the August 2025 stats from the Space Coast Association of Realtors, and our mission today is basically decoding this report. It seems to be telling a story of, well, deceleration.
It really is a perfect snapshot, isn't it? These monthly reports. They give you the market's temperature almost instantly. You look at what's sold, what's pending, inventory levels.
Right.
You can really see where the leverage is shifting between buyers and sellers. It's not just numbers. It's about understanding the dynamics.
Totally. So our goal here for you listening is to pull out that market heat, figure out the difference between single-family homes, SFH, and the townhouse condo market, TC.
Because they often behave quite differently.
They do.
Yeah.
And we want to see what opportunities or maybe cautions this August data presents for you.
And it's interesting. The report itself uses pretty cautious language, talks about a slight shift, the market evolving. But when you drill down, especially into that TC segment, well, slight might not be the word I'd use. We're really looking for where buyers are starting to gain an edge.
Okay, good point. Let's unpack this then. Let's start with the biggest piece of the market, single-family homes.
Sounds good.
So comparing August 2025 to August 2024, the cooling signs for SFH seem, well, pretty clear. Deceleration in key metrics.
Right.
Closed sales are down 2.4%. So 890 homes closed this August versus 912 last year. Not a huge drop in actual sales, but
the forward indicators.
Exactly. That's where the caution flags pop up. New pending sales, those are homes just put under contract.
Yeah, contracts written in August.
Both those and new listings dropped by almost 6%.
Yeah.
5.8% to be exact.
And that 5.8% drop in new contracts, that's really key for that segment. It tells you plain as day what happened in August. Fewer deals got written. Simple as that.
Okay.
And the slowdown, it directly impacts price and inventory. And this is where it gets pretty interesting for anyone thinking about buying. Well, the median sales price for single-family homes, it dropped 4.0% year over year.
4%?
Yeah. So to make that real for you, the median went from about $385,000 last year down to just under $370,000 this August.
Okay, so about a $15,000 drop at the median.
Roughly, yeah. A $15,000 difference over 12 months.
Now, a 4% drop, I mean, after the crazy run-up we saw, 15%, 20% year-over-year growth. Is $15,000 really enough to shift the power balance significantly, or is it just, a bit of a correction? Are sellers sweating this?
That's a fair point. It's not like the floor dropped out, but the key is the trend reversal. For years, it was just up, up, up. New record every month, practically. Now, prices are consistently pulling back. And, just as important, the month supply of inventory. That's up 12.5%.
Okay, 12.5%. Where does that put us?
It moved from 4.0 months last year to 4.5 months this August. Now, technically, 4.5 months is still often seen as leaning towards sellers.
Right, 6 months is usually considered balanced.
Exactly.
Yeah.
But that extra half month, it's psychological. It means buyers can take a breath. They don't have that same panic. They can maybe see a house twice, sleep on it, maybe even write an offer with, an inspection contingency, stuff that was almost impossible 18 months back.
Right, the return of normal process. That makes sense. But, okay, here's something that seems to contradict the cooling story a bit. Cash buyers. Even with sales volume and prices softening, cash sales actually increased by 15.5%.
Yes, the cash element.
What's that tell us? Does that mean the market's maybe stronger underneath than these numbers suggest?
It tells us a couple of big things, I think. First, you've got buyers, maybe investors, maybe retirees moving with equity who just aren't bothered by high interest rates.
Right. Mortgage rates don't matter if you're paying cash.
Exactly. They see these slight price dips maybe as a buying opportunity, so they prop up demand at a certain level, preventing a bigger slide.
Okay. And the second thing?
It ties straight into distressed sales. Or rather, the lack of distressed sales.
Oh.
The fact that traditional sales made up almost everything, with the median price right around that $370,000 mark, it confirms the slowdown, is mostly about financing costs becoming prohibitive for some buyers.
Not about homeowners being forced to sell.
Precisely. It's not widespread financial hardship. Just look at the numbers. Foreclosure REO sales, that's bank-owned stuff, only 5 closed sales. in the whole county for August.
God, only 5.
And short sales were just 6. Tiny numbers. So the cooling is market adjustment, demand pulling back. It's not distress-driven.
That's a really crucial distinction. So it's an evolution, like the report said, not some kind of crisis brewing.
Exactly.
Okay, let's pivot now, because the townhouse and condo market, the TC segment, seems like a whole different ballgame based on these numbers. Much faster change.
Oh, yeah. We definitely need to look closely here. If the SFH market is giving buyers a bit more time, the TC market seems to be handing them the actual negotiating tools. It's accelerating.
And it starts with a weird contradiction, doesn't it? Unlike SFH, closed sales for TC were actually up 3.2%.
Right. 193 units closed versus 187 last year seems positive on the surface.
So,
But remember, closed sales lag, that's deals likely written back in June or July. It's rearview mirror stuff.
okay, so what are the forward-looking signs saying?
Flashing red for sellers, basically.
Yeah.
New pending sales, again, new contracts signed in August plunged by over 10%, 10.7% actually.
Down.
And new listings were also down 11.2%. So the pipeline of future closings, it's thinning out fast.
Got it. So those higher closed sales were just leftover momentum. We should probably expect TC closings to drop in the coming months.
I'd think so, based on these pending numbers.
And if we look at price and inventory for TC, this is where that buyer leverage really shows up.
Oh, dramatically. The median sales price for TC dropped 5.4% year over year.
Steeper than the 4% drop in SFH.
Yep. It went from about $280,000 down to $265,000. But honestly, the real headline grabber for buyers here is inventory.
What happened there?
Massive jump. Months supply of inventory went up by 25.0%.
25%.
25%. It moved from 6.4 months supply last year to 8.0 months this August.
8 months.
That's double the percentage increase we saw in SFH inventory in 8 months. That pushes the TC segment firmly into buyer's market territory.
8 months of inventory. Let that sink in. If nothing new came on the market, it would take 8 months to sell what's currently listed.
Exactly.
That's textbook buyer leverage, isn't it? Sellers must be feeling serious pressure in that part of the market, properties sitting for much longer.
Absolutely. When you hit 8 months of supply, buyers have choices, lots of choices, and almost zero urgency.
Right.
So you combine that 5.4% price drop with 8 months of inventory, buyers can start asking for things. Inspections, repairs, price concessions. Sellers, they need to be priced really sharply or maybe offer incentives just to get noticed.
And did cash buyers play a role here too?
They did. Similar story to SFH, actually. Cash sales were up 14.4% in the TC segment. And again, traditional sales dominated. Median price there was $267,500. And distress, even less than SFH. Only 1 foreclosure or REO closing, 0 short sales.
1 foreclosure. Okay.
So again, it reinforces that this big inventory pileup isn't panic selling. It's just demand has softened due to financing costs or maybe just buyer caution, and listings are sticking around longer, driving up that supply count.
Right. Makes sense. So pulling this all together, what does it mean for you, the listener?
Okay.
How do we synthesize these two stories, the gentle cooling in SFH and this much sharper slowdown, especially the inventory jump in townhouses and condos?
Well, the common thread, the thing connecting both sides, is rising inventory and the resulting downward nudge on median prices.
Okay.
The overall message seems clear. Fewer homes actually closed in August compared to last year, yes, but inventory is up across the board. Buyers just aren't bumping into each other at open houses like they used to. They can shop around a bit more.
So for you listening, the relevance is really about leverage, isn't it?
I think so.
If you're a buyer, you simply have more choices now than you've had in quite some time. Now, the SFH market at 4.5 months, it's still relatively active. Sellers aren't desperate maybe, but there's pressure.
Right.
But if you're looking in that condo townhouse market, your leverage is considerably greater with that 8-month supply. And those falling pending sales and new listings just confirm the whole tempo of the market has slowed way down from that frenzy a couple of years ago.
Yeah, we really need to stress that finding. Buyers should definitely note their increased negotiating power, especially, like you said, in that TC segment, 8 months of supply. That's a genuine window to potentially get better pricing, better terms.
Okay, quick recap then. Single family market, cooling, but maybe gently.
Yeah.
Cash buyers are a floor. Inventory creeping up towards 4.5 months.
Yeah.
Townhouse condo market, cooling much faster. Big story is that inventory spike up to 8 months. Major buyer leverage there.
That sums it up well. And my final thought, just echoing the report's own interpretation, is that we've clearly shifted gears.
We're moving away from that period of breakneck speed, offers over asking, waived contingencies, all that stuff. We're heading back towards a market where things like contract terms, negotiations, the actual condition of the property, they matter again. It feels like a move towards maybe normalization, but like we saw, it's happening at very different speeds depending on if you're looking at a house or a condo.
Right, 2 different speeds. Now, here's a final thought, something maybe for you to chew on. Despite this really clear cooling falling prices, rising inventory, especially in TC, what's really striking is how few distress sales there are.
Still incredibly low.
Just 5 SFH foreclosures, 1 TC foreclosure, across the whole county in August. It begs a question, doesn't it? If this cooling continues, if inventory keeps climbing, especially if it climbs past that 8-month mark in condos, how long can those distress numbers stay so low?
That's the big unknown.
At what point does the sustained price pressure start to create more financial strain for some owners? Could that become the next factor pushing prices down further? That's definitely something worth watching closely as we head towards the end of 2025.
Well, that wraps up today's episode of RealiCare Reports, where real estate meets real life. For more updates, tools, and insights that will help you buy, rent, or invest with confidence, be sure to follow, subscribe, stay connected, stay informed, and stay ready. Until next time.